We all know that keeping teeth healthy is an art, a science, and sometimes a battle against an alarming amount of coffee that we take. But today, we are shifting gears from flossing techniques to finance, because just like cavities, taxes can sneak up basically whatever that we have, if we are not careful about it. So, to help us fight off the financial decay and keep more money in our pocket where it belongs, we have the incredible Samy Basta with us. Samy isn't just a CPA, he's like the full ride for your finances, the sealant for your savings, and the ultimate root canal for your unnecessary taxes. With years of experience helping professionals like you maximize the deductions and minimize stress, Sam is here to share his wisdom, his tips, and maybe even a few tricks that will help you keep your smiles on the face when you're filing taxes. So please give a warm and cavity-free welcome to Samy Basta. Samy, please.
Thank you very much, Bardia. It's really a pleasure to be here. Hello, everyone. My name is Samy Basta. I am a CPA based in San Francisco. My team focus on fractional CFO services, tax and accounting for small businesses. And I'm really excited to be here to talk to you about a lot of financial and tax area where you would all need as a business owner to pay attention to make sure that you're running your practice efficiently and effectively and optimizing your taxes, business and personal. So allow me to share my slides here and we can get started. All right, so can everyone see my slides here? Okay,
Yes.
Awesome, great. All right, so my agenda for today is I want to first talk about the importance of the financial management in your practice as a business owner, or what we call it, owner operator of your business. We also kind of cover the business structure. I think that's very important to understand your choice of entities, how your entity legal structure impacts your business, your finances, and your taxes. We also gonna go over the risk management, your financial risk management, operation efficiency. We're gonna spend some time on the cash flow to make sure we understand how cash flow works and what's a healthy cash flow looks like, and how can we monitor and review our cash flow, because this is, I believe, it's the backbone of any small business. And then of course, we'll cover the tax optimization and make sure we're, optimizing our practice, personal and business tax situation to make sure we're taking a full benefit and advantage of the tax code. Hopefully, I'll cover all this in 40 minutes, and hopefully we'll have some time for Q&A. So allow me to start first talking about your business structure. And this is one of my favorite subjects. I also like to not just talk about the tax implication of the business structure, but the actual business structure and how does it impact your business. So most dentists, the one we work with, you have one of two options. You can either choose the PLLC or the PC, the professional limited liability company or professional corporation. So understanding what goes with these entities, so both type of entities offer you liability protection. So this is the buffer that you need between you and the outside world. But when it comes to the tax implication, each entity, they offer different tax implication and different tax, benefits. For the LLC, unless you elect to be taxed as a C Corp or an S Corp, you actually don't get any tax benefits. And I know there's just a lot of misleading information out there that if I have a limited liability company or professional limited liability company, I have the asset protection. This is great, but it also helped me to minimize my taxes. When it comes to the PLLC, if you go to your accountant or a tax preparer or the IRS and I say, hey, how can I file my LLC? They have to ask you a question. How is your LLC is taxed? Is it taxed as a partnership? Is it taxed as an S corp or taxed as a C corp? So you have three options. If you have more than one member in your LLC, you may elect to be taxed as a partnership, or a C corp or an S corp. So C corp and an S corp, you don't need to have additional member or partner. But for partnership, of course, I mean, if you're a one solo single member LLC, you cannot file as a partnership. So the only choices you have are either C corp or S corp. Now, C Corp is a great structure, as we know, with the Trump tax reform in 2017, the TCJA, he lowered the corporate tax to 21%, and it's a flat rate. So it's not in bracket like your personal income tax, which is great. But it comes with some, issue, because with the C Corp, all your income in the C Corp, the entity will pay its own taxes, file its own taxes. So imagine that you and me and the C Corp in the room, we are three person. The C Corp is a virtual person. It's separated from you. Even though you own 100% of the corporation, the corporation pays and files its own taxes. So if you try to tap into the profit in the C Corp and take that profit out or some of the profit out, then you get taxed again. And that's what we call the concept of double taxation. There are a couple of tax strategies to mitigate or minimize that double taxation, but just be aware that the corporation will pay taxes on the profit. You, as the owner or the shareholder, if you try to get profit out of the corporation, the C corporation, then you still have to pay taxes. That will be taxed on your personal income tax. On the other side, the other token of the corporation is the S corp, which is the very popular just because of, number one, it's a pass-through. So all the profit and losses of the S corp will passes through to your personal income tax. If you have a year with losses, if you buy a lot of equipment, if you have a accelerated depreciation and that created a loss, as long as you have bases in the corporation, you can enjoy those losses. So the losses can offset your other active income like W-2 income or any other ordinary income. On the other side, one of the biggest benefit of the S Corp is the self-employment exemption. So as an owner-operator of the S Corp, you take wages, and that's the only part of the profit that will be subject to payroll taxes. So on the wages that you take, which is mandated by the IRS, you're paying FICA and Medicare, just like any other employee. You're getting your W-2 at the end of the year, you're getting your paycheck. So that income is subject to federal, state, FICA and Medicare payroll taxes, 15.3%. You pay half of it, 7.65%. And the corporation paid the other half, which is, by the way, is an expense deduction, 7.65%. All your net profit, other profit that you take as distribution, that's not subject to self-employment taxes. So that's a great benefit. In addition to that, the TCJA, the Trump tax reform, make it more appealing with the qualified business deduction. So on the top of this, if you are under an income threshold, you can get additional 20% on your net profit. So think about exemption from SE tax. That's about 7.65%. Your employer portion, add to it 7.65%, the employer portion. Also, if you maintain your profit or your total income, adjusted gross income, under a threshold, you also get additional 20% on the your net profit, the pass-through profit. This set to expire next year, but since Mr. Trump is in the in the White House, everyone expecting, and he actually talked about his plan to extend that TCJA and make it a permanent, which is going to be great for everyone. So just understanding the big picture between the LLC or PLLC and the PCs, they both offer great asset protection, but everyone has a different impact or implication on your personal income tax. Separation of finances, I think you've heard some version of this. The IRS doesn't like commingling. Commingling is prohibited. It is illegal. And that's the very first thing the IRS auditor, if you get audited, will look at. They will look at certain expenses. They will look at your meals and entertainment. They will look at your office expenses. They make sure there you didn't sneak any personal equipment there. There are certain accounts in your chart of accounts always under the radar screen. So you want to make sure if you're paying anything with your personal credit card or personal account, you make sure you get reimbursed from your corporation. If you're incorporated, if you are driving a car, you make sure you have a clear and accurate mileage log. That's the very first thing they will look at. If you're getting reimbursement for your home office, you make sure you have documentation for how much mortgage you use, how much property taxes you paid, and the space that you use regularly and exclusively for business. I myself have my home office. I have my, second office in San Francisco. I drive to my office, but sometimes I work from my home office. I get reimbursed from my corporation the same way. I, draft an expense report, but exactly how much, what's the space here that I'm sitting for my home office, all the expenses that I, whether it's utility, internet, mortgage, property taxes, but I gotta have documentation. You have to show the IRS. I also recommend that taking pictures of your home office, because if you get audited, they just wanted to see that the auditor maybe not be knocking on your door, but you have to send the proof to show that I actually have an exclusive place or space that I use for my business. So separation of finances, that's very important. I also want to take a couple of minutes to talk about the accounting software. It is really crucial to have to track your income and expenses in a software. I've been using Intuit product. QuickBooks is, as you've probably, most of you use QuickBooks online. It's a great software. Some people, they will think, well, if I have a good practice management software that shows all my collection from the insurance, that will be enough to produce my financial statement. That's actually not enough. For one reason, if you're getting, for example, if you're collecting cash payment, if you're financing for some procedure, doing client finances, all these payment, it's not going to run through your insurance payment. So also for all your expenses, to have that clear breakdown for each type of expense and have a clear chart of accounts that an accountant, a tax auditor, and IRS will look and understand, that's very important. So, keeping a good, track records of all your accounting expenses, make sure you reconcile that, hire a CPA or hire an accountant, hire a certified bookkeeper to understand. You also need to review this number with them, because that's very important. Not just someone to reconcile your account and spit out a report and send it to you. You need to sit with your accountant and go over these expenses, and that's what any good accountant will do for their client. So we meet with our clients a minimum of 4 times a year. We meet with them every quarter. We close the quarter. You look at the chart of accounts. You start analyzing. You look at the trends. You understand what's your current ratio, what's your cash flow ratio, what's your cash burnout. All these trends and key performance indicator should be at your fingertips to help you maximize your tax benefit and understanding how your business is performing. So this is all about the business structure and the financial health. I'm going to move down to risk management. And this is really important to understand how risk management work. I'm just going to focus on the financial risk management. A lot of what I've seen, you go just by, month to month, you really don't dig in your number. You don't look at your debt to income ratio, and all of a sudden, you wanted to upgrade your equipment or buy more equipment, and you're trying to get financing for your equipment, and the lender will look at us like, well, I cannot give you finances because your debt to income ratio is too high. You have a lot of credit card debt on your balance sheet. Your cash flow or cash reserve is not really healthy. So these are the ratio and the area that you really need to pay attention to, and you need to review them on a regular basis. Of course, compliance with HIPAA and OSHA. You always want to make sure that you are compliant. Insurance malpractice. When was the last time you looked at your insurance malpractice? As you grow, as you increase the number of clients and your revenue grows, you really have to, your malpractice should should have enough insurance to cover any future litigation. God forbid, if anything goes bad or goes south, you want to make sure that you review your malpractice and insurance coverage on a regular time. um, when it comes to operational efficiency, this is really important because we've talked about the practice management software and how it's important to have a good practice management software to handle all your scheduling, your billing, your communication, the automation. As we know, the world's going with automation, standardization with the AI. Wave right now. Everyone just trying to get on the wagon with the AI. You really have to think about: am I operating efficiently here? Are any of these tedious tasks that can be reduced or minimized if I can automate that task? For example, when I go to my doctor, I see Dr. Loomis here in Redwood City. He's a great dentist. When I see him, before even I walk to the office, I get that text or email, a day or two. Hey, please fill out that form. Let us know if there's any change in your health. When I walk into the appointment, there is no time wasted here. I walk in, they already have all my information. I go straight to the chair, finish the business, and walk out. This can really save you, if you think about 5, 10, 15 minutes, you save in every client that walk in that you have to hand them the sheet and explain the questions. That can add up 10, 15 minutes per customer. I don't know how many clients you see per day. That's all non-added value that can be saved, that can be automated to save you more time. When it comes to staffing strategies, well, do you know that your labor, your wages and salary usually range between 22 and 26% of your collection? That's a big chunk of cash that you pay for your salary, and that doesn't include yourself as an owner operator. So you gotta look at these numbers on a regular basis. You need to understand: am I overstaffing? Am I maximizing my human capital? Am I utilizing all the resources I have? Maybe I'm understaffing. Maybe I'm growing and adding more clients that I need to look in recruiting and adding more staff. So those numbers also will be on your KPI, key performance indicators that you need to discuss with your accountant. And that's what having a good financial advisor like Dr. Hariri, or a good accountant, proactive, someone that understands your industry and your space, someone really look at all these ratios and all these numbers. And this is how, how deep you should go into the numbers. I know a lot of people, and you're a busy professional, and at the end of the day, you just want to say, I don't want to pay too much taxes. But you know what? There is a lot of areas that you can cut and you can save, and you can mitigate those taxes that hitting you at the end of the year by operating, efficiently and looking at all these details in your chart of accounts. So salary, wages, that's a big area that you really need to pay attention to. Inventory management, you want to make sure that you reduce your waste. When was the last time you talked to your supplier? Negotiate discounts or looking at any new supplies that you need, and are making sure that you have enough stock for the next month or two. So all these area that affecting you, if you overstock your supplies, this is basically cash sitting there that you're not utilized. If you're under, if you don't have enough inventory, that's also, you can run to, out of inventory. You have to get an order. You may have to pay additional shipping and handling. You may have to put that on your credit card. So managing all these numbers and looking at your P&L and balance sheet, making sure all these numbers make sense to you, it's crucial. All right. Talking about the cash flow. So cash flow, that's one of the biggest area that, usually ignored when it comes to financial. Well, cash flow, we got to understand it has two legs. So you have cash out and cash in. So you really have to look at your collection. Number one, that makes the biggest chunk of your cash flow. Am I getting paid from the insurance on time? If there is anything that can be done to expedite those payments, so you don't have to wait for 30, 45 days or 60 days to get paid from the insurance. If you offer your clients financing, or if someone is looking at your accounts receivable aging, if someone looking at all these, old balances for 90 days and 100 days, are you reviewing this or cleaning your aging report with your administrative staff or your accountant? So those area, the more you can look into all these trends and understand that there is nothing that really clogging your pipe of cash, the cash inflow, you expedite the cash inflow and having that revenue handy and available that you can spend it, or you can, if you need to hire, upgrade equipment, or spend on capital improvement. So this is one leg of the cash flow. Now look at the other side, the cash distribution or your cash outflow. Are you, do you have the best terms with your supplies? Are you, are you paying more for your supplies than what you should be? Are you overpaying your taxes because you're not planning for your taxes? And we're gonna come to that on the tax, part. But this is all the two legs of the cash flow. You really have to constantly reviewing and looking at your cash inflow and your cash outflow. For example, I've seen some practices that, when they come to upgrading their equipment and, trying to finance their equipment. Well, if you don't have a good credit, if you're not paying your bills on time, if you have a big credit card or loan payment, all these affecting the terms when it comes to negotiating for upgrading equipment. So again, all these trends that will show on your regular meeting with your CPA, regular meeting with your financial advisor, regular meeting with your staff to make sure all these areas and all these trends are reviewed on a regular basis. Cash reserve, that's very important for any emergency. Do you have 3 to 6 month cash reserve for your emergency? I mean, we've seen what happened with COVID. All of a sudden, the practice, a lot of practices closed. You had payroll that and you have clients that you're not sure how to see them, and then all the cash collection, people start paying slowly their balance because the pandemic. So when you have a good cash flow reserve, you really need to have that handy to handle any type of emergency, and that's part of maintaining a good, healthy cash reserve. Well, talk about taxes. I guess that's what we're here for. Most of us wanted to know, well, how about my taxes? Well, tax saving strategies, there are a lot of strategies. And I, didn't mean to bore you with a lot of technical, but just talking about, taking, 30,000 feet above, view. Let's talk about taxes. What's the biggest expense you have after payroll? It's probably going to be depreciation because constantly looking to upgrade your equipment, upgrade your X-ray, upgrade your buying more supplies. So you really have to look at what's my plan for this year, what's my plan for the next year, when are you planning to upgrade? Am I taking advantage of my depreciation? Understanding how depreciation work is really important. So we have two types of depreciation. There is Section 179 and there is a bonus depreciation. The bonus depreciation that in 2025, it got reduced to 40%. It used to be 100%, now 60%, and this year's 40%. Hopefully, the new administration will bring it back to 100%, and that's the talk with Mr. Trump administration. They trying to make the TCJA, the Tax Cut and Job Act, permanent, and part of it is bringing the bonus depreciation back to 100%. But let's understand why is that important. Let's say you need to upgrade, you need to buy another chair. I don't know, costs, $30,000, $40,000. The IRS, if we have the bonus depreciation, allows you to expense that, the cost of the chair in the year that you buy it. So instead of depreciating this over 5 or 7 years, if you have enough revenue to absorb that cost, then you can depreciate it right away and get that big loss. Bonus depreciation allows you to go beyond your net income. So let's say if your income, you have $500,000 revenue in 1 year, and you have a chair that costing $50,000. With the bonus depreciation, assuming that they bring it back to 100%, you can expense that $50,000. But if all your other expenses bring your revenue down to zero, guess what? Taking that $50,000, it allows you to have a loss of $50,000, so you can actually go beyond your net profit, creating that loss, allowing you to use that loss to offset other ordinary income. Section 179, on the other hand, is great, but Section 179 doesn't allow you to create a loss. So if if your expenses are greater than your income, you only can carry zero to your personal income tax, but any excess loss gets suspended to the following year. So next time when you go sit with your CPA, you should ask if you have a big purchase or big capital improvement or upgrading your equipment. Just ask them the question. Am I taking advantage of Section 179? Am I taking bonus depreciation? Ask him to explain what the difference. So these are two areas that you need to be aware of. But also thinking outside the box. Thinking if you're planning to buy or invest or buying your home or buying an investment property, do you really want to maximize your depreciation and showing zero income? Probably not, because you know what the lender will do. The lender will go back 3 years when you put your application and wanted to look at your income. So, and that will bring me to my point. Planning in everything. You need to sit with Dr. Hariri, my financial advisor, or with your accountant. I'm planning to invest. I wanted to buy a new home. I have a big purchase coming. I need to finance for, $100,000 equipment purchase next year. What is the best scenario for me? What my income should like? And I always believe that the taxes, in my view, after more than 25 years, it's all about financial presentation. Your taxes is not just number. You're plugging the number and looking for a big refund. The taxes, your tax return tells a story to the IRS, tells a story to the lender, and this tells a story to the investor. If you try to invest, the very first thing the investor will ask you is, show us your tax return. If talking to an IRS audit, You want to present your number in a way to make sure that you're not on the radar screen, you're not raising any red flag. And that, if I can call it, the creativity for a CPA with their experience and someone with no experience. You really need to understand how the IRS system works. The IRS system algorithm work with trends. They will look at trends. Your income is consistently growing, or your income is consistent for the last 4 or 5 years. If the system will catch, 1 year big meals and entertainment went up 150%, the system automatically will catch that, will catch that number and start asking questions. And that's how people usually get random audit or targeted audit, because if you don't maintain that consistency without any proof or substantiation of these numbers, people get in trouble. So understanding how to present your number to the IRS, how to present your number to the lender, if you're trying to finance or secure financing or buy a home, this is very important. What I'm trying to say is maximize your tax saving is great. We all don't want to pay more taxes than what we legally are liable for. But sometimes you have to sacrifice the tax saving for a higher goal. I'm buying property next year. I really want to show more income. I want to show more consistent income. I want to take a bigger chunk of the profit, even if I'm paying payroll taxes, but I want to, show a higher W-2 for the last 3 years. So it all comes to planning and your strategy and your goals. So keep that in mind when you talk to your CPA, when you talk to a financial advisor, when you talk to your lender. Make sure all these people are talking to each other and coordinating to help you to achieve your goals. All right, so financial review, that's also pretty important. Think about, when was the last time you sat with your financial advisors to look at your number, to look at your cash flow, to look at your retirement? Are you putting enough money to your retirement? Do you even have the right retirement plan? Dr. Hariri, my financial advisor, he's brilliant. He showed me a couple of retirement plans that you can put in 1 year more than $250,000, probably higher this year. Something is called defined benefit plan. So you need to sit with your financial planner a minimum of every quarter. That's what Dr. Hariri does with myself and my business. We wanted to make sure you are on track to achieve your goals. Are you planning to hire in 5 years, in 10 years? Are you looking to sell your practice? Are you looking to find a key employee to buy your practice out? What is your goal for the next 5, 10, 15 years? And you need to work with someone that can really help you to achieve that goal. So again, paying the minimum taxes is great. Optimizing your practice is great. Maximize your tax saving is great. But that means, and that works differently, depends on everyone's goal and situation. So just keep that in mind. So the key takeaways here, I just wanted to really encourage you to think outside the box, to look at your financial health of your practice and of your personal finances in a big picture. Sit back, look at your number, make sure you meet with your financial advisor, with your CPA, with your staff on a regular basis. Make sure all your KPI, your key performance indicator, are at your fingertips. Understand what your current ratio means and how it works. Make sure you have a healthy cash flow. Make sure that you know what's your cash burnout and how to improve it. So all these areas that really can help you to achieve a financial success for a long term. I think I'll wrap it up at here, and I'll see if there's if we have any time for questions.
Thank you so much, Samy. We have 4 questions in the Q&A. I don't know if you see the questions, you want to address them.
So Samy, thank you for joining. Absolutely, you're very welcome. So good afternoon. Thank you for, okay. Okay, I think I don't have access to the questions Bardia here.
I can read it here. So one of them is, so the first question is, now that I'm mostly retired with very little income, I used to use Quicken for my tax returns with TurboTax, but they recently recategorized all of my categories without saving the original item labels. What alternative is there to Quicken?
Very good question. I would say Quicken, I honestly haven't used Quicken for a long time. I know it used to be popular, probably like in the 90s or so. QuickBooks alternative is a really good alternative. QBO, it wouldn't cost you that much. Maybe if you get the basic, the essential plan, it'll be roughly about $20, $25. And if you work with your CPA or your bookkeeper, you usually can get you a discount for the first year. And I believe, but don't hold me to that. I think you can convert your Quicken. There are some third-party software that can convert your Quicken to QuickBooks. QuickBooks just have a better reporting, so you can actually run your P&L balance sheet. You don't need even to be savvy with QuickBooks. It's pretty easy. It's very friendly, user friendly, and their support is great. That's just my experience. I think you should look into converting or upgrading to QuickBooks. I think that would work better for you.
Thank you. Second question, for the labor costs, the 23 to 26%, is that for gross pay?
That's gross pay. That's right. So that includes your gross salary and wages and the payroll taxes. So that's the average that we see in the dental space.
Thank you. For the cash reserves, should it be for fixed costs times 3 months? Oh, the cash reserves should we have 3 months of expenses? Probably that's the question. Yeah.
Yeah, I don't think you should worry much about your fixed cost. I think I will worry about my variable cost. So think about my rent or mortgage, at the office, your salary, which is the biggest deduction, maintenance or repair, any supplies like a bigger supplies that you use for practice, utilities, internet, phones, all the variable cost that you can average that per year, and you want to make sure, I'm sorry, per month, and you want to make sure you have that saving, that 3 month saving, you put it away. You may need to tap into it sometimes, maybe just like if you wanted to, invest or upgrade, and I don't have the cash right now, I'll take it back. Make sure that's at least a minimum 3 month replenish all the time and sitting in your saving. That's always the best practice.
Thank you very much. The last question on the chat is Empower safe?
Is Empower
Safe. Empower, I believe they're referring to the financial institution Empower. I'm not too sure.
I'm sorry, I'm not familiar. Is
Empower.
that
Yeah, okay. So what I understand, Empower is a financial services company. So I'm not too sure what we mean by safe.
Yeah, I'm not
But you
familiar with that. I
possibly,
apologize.
yeah, I can refer to, I mean, if that's what they meant, Empower as financial services company, yes, is a financial services platform like another company like Fidelity, like Vanguard, like ChargeShop or E-Trade. But in terms of safety, I'm not too sure. Depends on the allocations, depends on the investments that you choose. Obviously, when it comes to retirement accounts and investments, they are not FDIC insured. So you need to know that there's nothing guaranteed when you put money there. It depends on the portfolio and the performance of the market. So definitely you need to discuss your risk tolerance and your liquidity needs with your advisor, and we are happy to help you as well.
Here we go. We got the expert in the house here. Thank you.
Thanks. So another question, can you please talk about some strategies for dentists who own the real estate as well?
Great question. I'm glad that you Robert asked that question. So if you own or and I assume that you mean that you own your office. So your office, you bought your office. You're not renting your office. So if you have the real estate, you own the office real estate, the commercial real estate. You always want to separate that from the management company, from managing your practice. So my advisor, my recommendation, I'm sure Dr. Hariri will agree with me, is for asset protection, you always want to separate your assets from your management. If someone will come and sue your management here, all what they can get you is your computer and your office and your, and office supplies, but they have no access to your assets. So it's always recommended to wrap your commercial office where you practice in an LLC, a pass-through entity. You have your practice charging rent to your real estate, so that would be the income that you need in the LLC that wrapping or holding your assets to pay for all the operation expenses, your mortgage, real estate, property taxes, all this stuff. And then the same time, the rent that you're paying is tax deductible on your management company. So always think about, I am managing my practice here. I want to make sure that any creditors doesn't have access to my biggest assets here. Your commercial real estate is also separated here, protected through the LLC. Also, that really works great if you decided to retire or sell your practice. You can sell your practice here, but you still own your real estate right here in the LLC. And whoever the new buyer, you still can charging him rent, so that will create a passive income for your retirement. So that's a great strategy work during your practice and after your retirement.
Thank you, Samy. One more question. Any strategies for new startup practices compared to acquisitions when expenses are high and revenue is low for the first 2 to 3 years at least?
I mean, my preference is always before you jump into an M&A deal or acquire someone practice, always think about, what the cost of, starting your own. It's really with all the new technology that we have and, social media and marketing and SEO and website, it's not that hard to start your practice. You may struggle for the first or second year, and there is a lot of tax benefit of starting. Like, so you have startup expenses, you have organization expenses up to $5,000 you can expense in the first year. If you have a loss, even if you're running your practice as a sole proprietor, the IRS wouldn't look at your losses for the first 2 out of the 5 years, so there's just a lot of benefits of starting on your own. Also, creating your personal brand, that's always important. I've seen through the M&A, I'm sure Dr. Hariri have seen that before. It's really hard to fit in someone's shoes, compared to I'm creating my personal brand. It may take me, more time. That maybe sounds like a longer road, but at the end, this is your new baby that you're creating and you're growing and you have full control of your operation. That would be, I mean, some M&A, are great if it works out. But I always, you have to look at the, what's the cost of it starting on my own? Is that feasible? Is that something that you can put on for the first 2, 3, 5 years until you start, creating your brands and promoting your practice off the ground?
Thank you, Samy. One more question. Thanks for describing the LLC real estate question. Quick follow-up. Is it better to have the real estate LLC as single owner or say a 50-50 partnership with a spouse?
That's a very good question. I really love that question. Good question, because in both ways, whether you are a single member LLC or a partner with your spouse, your pass-through income, profit and loss will show on your 1040. I would say if you have multiple investments, so let's say you have your commercial space, but you have other couple of rentals, I prefer the partnership, because the partnership only shows as one income from K1 on your 1040. So it takes an IRS agent more work to dig in if they want to audit you and to trace that number to your partnership. Versus if you have just, if you're a single member LLC, right, and you put all your income and expenses, I'm not sure if you're probably familiar with the Schedule E. So you have your income, all your expenses listed line by line. In my experience, by doing this, you make yourself an easy target for a target audit. So if the audit, let's say, just target audit, want to look up everything, all the commercial property or real estate, Schedule E with 20,000 of more or more of a mortgage interest or so. If your number is listed there, it's just easy for the system to target and see all your number versus when you have a partnership, you have just one line, showing in your 1040. That's my preference.
Thank you very much, Samy. Very informative. Uh, we're waiting for more questions. In the meantime, Samy, would you be able to kindly show your slide with your contact details so that
Yeah, absolutely. I think I didn't put my contact here, but if you
okay.
go, I mean, the easiest way, if you go bastacpa.com, you can, look at what we have. We have a lot of blogs and videos, and you can schedule actually a complimentary call from there. We offer 15 minutes complimentary consultation for anyone. Even if you're not, if you're not looking for CPA, if you have just a couple of questions that you want to answer, I'm more than happy to spend time with you and answer your questions.
Thank you very much. I also put it on the chat, your website.
Thank you.
Uh, Thank you. We appreciate it, Samy. Please, ladies and gentlemen, please reach out to us if there's anything we can help. I'm grateful to Samy Basta and grateful to Jim for making this happen. We're looking forward to be a resource for you. Thank you.
Awesome. Good to see everyone. Thank you.